today. My name is Marcia Nedland. I am one of the organizers for the Middle Neighborhoods Community of Practice. And one of the things we do is a monthly webinar series where we present about topics that are, having some kind of impact on middle neighborhoods and on the work that practitioners do there. So homeowners insurance is our topic today, and we can tell, I mean, we all know it's a really big deal. It's getting to be more and more of a big deal. And we can tell by the number of people who signed up for this session that you agree with us. The title of our session today is How Rising Homeowners Insurance Rates Threaten Middle Neighborhoods and What Can Be Done About It. We're very lucky to have someone who wrote a really illuminating report on this topic, on the topic of homeowners insurance and how many Americans are going without it altogether and what some policy recommendations are. That's Sharon Cornelison from the American Consumer Federation. And formerly, you might know her from the Joint Center for Housing Studies, where she was a fellow. So we are going to have Sharon talk to us today about that report, including some new data that hasn't been published yet. And then we're going to have a couple of members of our steering committee who are middle neighborhood practitioners themselves react to her report and also tell us a little bit about what's happening on the ground in their middle neighborhoods. But first, we always like to do a poll to understand what sector people are coming from. We generally have a lot of nonprofits, and our second most common group is local government. But we always like to keep tabs on that and know who it is that we're reaching. So if you could just do the poll, that would be very helpful. So far, it's looking like our patterns are intact. Nonprofits and local government, state government. Real estate industry, that's interesting. Okay, and I think we can close that. We had 75% of you answer the poll. So it does look like we've got 57% nonprofits, 24% local government, a little bit of state government here. We've got 5 people from the real estate industry who may be even realtors, a financial institution rep, and a few others. So thanks everybody for that. So I'm just going to do a couple of slides for those of you who don't know what middle neighborhoods are or who we are at the Middle Neighborhoods Initiative, and then we'll jump into the content for today's webinar. So we are a national initiative that is mostly volunteer run, but is focused on mobilizing attention so that we can reverse what's happening in America, which is the disappearance of middle neighborhoods, either through sort of benign neglect and continued decline or gentrification. We do this through a handful of methods. We have a community practice, which is the body that is hosting the webinar series. And that can sort of is a way to network practitioners with policy makers and researchers. We have a research function, so we occasionally do research or co-sponsor research or work with researchers to provide access to our practitioners on topics that are relevant to middle neighborhoods. Policy analysis and advocacy that will support issues like housing, lending, and community development that relate to middle neighborhoods, and communication strategies. The co-hosts of this Middle Neighborhoods Initiative organizationally are the National Community Stabilization Trust, NCST, and NeighborWorks America. So we want to thank them. And then we also have a steering committee that advises them around this initiative, and 2 of those members are with us today. So what is a middle neighborhood? It's mostly, these are the neighborhoods. We don't have hard and fast stats or lines in the sand about income, but they are the neighborhoods that are neither the most distressed in your community, nor are they the healthiest. Usually that brings to mind right away certain neighborhoods for people. They were probably mostly built as neighborhoods of single-family homes for families with children, which is one of the sort of reasons why, just sort of market trend wise, that demographic is declining in the country. And so the original purpose for these neighborhoods is needing to shift. They tend to be still well more than 50% owner occupied, and that has a lot to do with why homeowners insurance is such an important topic. Owner occupancy in middle neighborhoods is one of the things that makes those neighborhoods places that contribute to the stability of cities and provide a place for households to do things like buy their first home, raise children, send them to the public school district, and all of that. But that owner occupancy has been slowly eroding. Most middle neighborhoods had much, much higher in the 90% range owner occupancy when they were first established. Their housing stock is aging. It's still in generally acceptable condition, but we find that it often lacks features and updates that allow it to compete well for today's home buyers. Smaller homes that had fewer bathrooms, maybe only one bathroom, kitchens and baths that haven't been updated to today's standards, et cetera. One of my favorite things about middle neighborhoods is that they are those mixed income, mixed race and ethnicity neighborhoods that most of us in community development have been trying to create when we work in more distressed neighborhoods. So they are those places in our cities where the American dream happens, right? And it's where people sort of encounter the full diversity of people and incomes and everything else that make the world revolve. So those are characteristics of middle neighborhoods. Okay. I do, yeah, that's probably good. Let's go ahead and skip for a second and to the donation slide. The donation slide. I think it might be there we go. We did want to, because we're talking about insurance and we've had two recent really, really tragic natural disasters, we wanted to put up two opportunities for donations to assist in the recovery from those disasters. They're both NeighborWorks organizations. Neighborhood Housing Services of Los Angeles County has a wildfire assistance fund. You can see the link there, and I'll have Ann put those links into the chat too so that you can click on them. Mountain Housing Opportunities in Asheville is also collecting donations at their hurricane resources site. We want to wish them well in rebuilding and hope that sometime very soon that the insurance market becomes stabilized in a way that supports those communities. There's also a blog if you want to read more about the work that those organizations are doing there to the left. So back to, I think we can skip the mapping slide for now, but we can go back to our introduction. Sorry, I'm really making and work about organizing or moving around on slides. So I mentioned Sharon Cornelison. She's the Director of Housing at the Consumer Federation of America in Washington, D.C. And she has been doing just really amazing research, just like she did when she was with the Joint Center for Housing Studies and in previous work that I'm sure she'll tell you about as sort of a sociologist who embeds herself in communities. She knows a lot about the latest on homeowners insurance and who has it and who doesn't. Then to give some local information to how these insurance issues play out locally, we have Bob Pippick, who is the president and CEO of Healthy Neighborhoods, Inc. in Baltimore, Maryland, who which is an organization that does a lot of homeownership development work and support to middle neighborhoods there. And Tiffany Smith, who's an urban leader in residence right now at the Mansueto Institute, but has been also a practitioner at NHS of Chicago, where she's done really interesting hands-on work in a very practical way that all of us can replicate around helping to get our homeowners in the best position possible as they move forward in this sort of arena of rising costs. But we're going to start with Sharon. So the biggest chunk of our time is going to be Sharon presenting her findings to us. And then we're going to move into some discussion with Bob and Tiffany and bring in some of your Q&A as well. So let's see if we can hand it over to Sharon. Sharon, thank you so much for joining us. I feel very fortunate to be able to access you for our audience and to hear the inside scoop of your report.
Yeah, thank you so much, Marcia. I really appreciate it, and I really appreciate kind of thinking about how this work relates to middle neighborhoods and also what's happening across the country right now. So looking forward to the discussion and also hearing from people in the chat kind of what they're seeing across the country. So this report exposed, we published it last March, but it's still timely. It's become part of a national discussion, like after Hurricanes Helene and Milton, and of course the LA fires. We're starting to kind of see this issue more and more pop up in national discussions. So I'm excited to kind of be able to contribute to that through this data-driven work. I wrote it together with the insurance team at CFA. I will kind of lay out two main reasons how we kind of started to think about uninsured homeowners specifically. So one of these reasons is a more personal reason. Like as Marcia was saying before, I have been sort of embedded in different communities as a sociological researcher. So I lived in Detroit for 3 years in a very depopulated neighborhood. And while living there, I firsthand witnessed a lot of homeowners not having homeowners insurance, right? It was very difficult to find affordable insurance, and because these were older homes and they had sort of visible defects already on the outside. Some of them did not even qualify to get insurance altogether. So I saw a lot of homeowners kind of cope with this, and they were always at risk of going from homeowner to homeless. So I'll just give one example, and that's what the pictures here are about. The house on the left was a house owned by Lakeisha, a longtime Detroiter, and she was a very proud homeowner, even though she owned literally the last house on her block. But it was her own, right? She bought it, and she's very proud of it. But she did not have insurance, and she did not have sort of cash reserves to kind of do home repairs as they came up. So one winter, her roof started leaking, and some guys from the neighborhood helped her put a tarp on the roof, but it didn't really help. And then another summer, her basements started flooding. Street flooding is common in Detroit, partly due to climate change, right? So there's sort of everyday disasters that happen, even if they're not nationally declared disasters. So she had issues with mold in her house. And the situation became so bad that at some point she had to basically abandon her house and move in with family. So the picture on the right is when I came back to Detroit. This is in 2023. So a couple of years later. And I found that Lakeisha's house was not there anymore at all, right? So she had lost her house and the city had demolished the home. And now we just have this field, right? So I think it illustrates kind of what can happen when homeowners do not have insurance. And I think Detroit is maybe an extreme, unusual case, but it's sort of at the forefront of what may happen in a lot of other communities across the country if we don't solve this crisis, right? So, and that was the second reason why we did this report. We started hearing kind of stories around the country that this was starting to be an issue, not just in poor neighborhoods or poor rural communities, but that even sort of more moderate income homeowners were struggling with rising insurance costs. So the slide here, I'm sharing a map from a forthcoming report. It's coming out either next month or in March. And in that report, we look at premium hikes across the country and how much premiums went up from 2021 to 2024 in all zip codes across the United States. So this map just shows sort of the average annual premium homeowners are paying for a $350,000 replacement value. So kind of a standard, like a middle neighborhood home. And we see that, of course, Florida does stand out with very high premiums. But in fact, we see, some states in the middle of the country, kind of in the Midwest, also facing really high premiums, right? So it's not just a crisis that's unique to California or Florida or even North Carolina right now. It's really starting to impact homeowners everywhere. So this is why we wanted to kind of start looking at some of the impacts of this, right? So, which homeowners are uninsured? Who are the most vulnerable homeowners, and where do they live? So that was the inspiration for our exposed report that I will be talking about today. So this report answers three main questions. So kind of basic questions, right? That we just didn't know, we didn't have enough information about. So how many homeowners across the country do not have homeowners insurance, right? And then second of all, who are these homeowners, right? Who is most vulnerable to go without insurance? What kind of homes do they live in? Do they have a mortgage? These kinds of basic questions. And then finally, we looked at the total market value of all uninsured homes owned by homeowners, right? Like what's at stake here? What's the sort of total risk that we're running? That's not just individual risk, but also kind of collective risk. So as I started this report, one learning was that there is very, very little public data on homeowners insurance. There's very little data available. The Federal Insurance Office just 2 weeks ago released some data. So if you're interested in looking at data at your zip code level, I would encourage people to kind of go look for that. It's kind of an accessible Excel sheet. So that's new data, but when we were doing this report, it was very difficult. And I actually kind of found some hidden variable in the American Housing Survey to do this report. So the findings today are nationally representative, and they're based on a survey of around 32,000 homeowners done by the US Census. So it's based on public data. All right, findings. So first, I will give you a little bit of a high-level overview of the findings. So overall, we found that 1 in 13 homeowners nationwide did not have homeowners insurance in 2021, which is what our numbers are from. So that's 7.4% of homeowners, or more than 6 million homeowners. And it's not equally distributed across the country or across all kinds of homeowners. They're disproportionately lower income. They're disproportionately homeowners of color. Most of them have no mortgage or have no mortgage anymore. And we also saw that lack of insurance was much more common among people who had inherited their homes. Overall, we found that around $1.6 trillion in property value of properties owned by homeowners. So this is just those owned by homeowners. We're not even talking about, rentals or, multifamily. Like we're not even talking about that. So just by homeowners is not covered by homeowners insurance. So this means that these individuals are exposed, but also that, collectively in communities, these homes are exposed. So I'll talk through some of those findings one by one in the next slides. First of all, I think it's very important to understand that most uninsured homeowners are homeowners that do not have a mortgage anymore or do not have a mortgage, right? So we found that only 2% of homeowners with a mortgage reported having no insurance, whereas for homeowners without a mortgage, that was 14%. So that's much higher even than that national average. And this is because lenders, as long as you have a mortgage, they require you to keep some sort of homeowners insurance to protect. They do this because they need to protect the collateral, right, that underwrites the loan. So we think that this 2%, and this is borne out by some other data that we looked at. These are people that are actually what's called enforced placed insurance. So if you are a homeowner with a mortgage and you fall behind on your regular homeowners insurance, or you cannot find anything that's affordable for you, your lender will put you in what's called forced placed insurance. And as a homeowner, you will still pay for it, right? It will be added to your mortgage payment, so you will still pay for it, but this forced place insurance only protects your lender, and it's often much more expensive than sort of regular homeowners insurance. So I think it's an important topic to be aware of, and an area of concern as we kind of think about, homeowners in distress. Okay, so we also found that homeowners with lower incomes were much more likely to go uninsured. So if you just look at income, like for households that make less than $50,000 a year, 15% of homeowners did not have insurance. And then if we look at poverty rate, so homeowners that live in poverty based on, what the census defined as poverty, 22% of these homeowners did not have insurance. So we can kind of see that it's, the homeowners who are least likely to have the financial resources to, face a disaster or, an incident. They're most likely to be vulnerable, to be exposed, right? To be without insurance. So I think it's not an easy choice that people make. People make this choice under financial distress, right? It's not like, well, I'll just go without. It's a difficult financial decision that people make. There's also a lot of variation among types of homes. So this again in 2021, it was pretty shocking to see that actually more than a third of homeowners of a manufactured home did not have homeowners insurance. So this housing stock is uniquely vulnerable. And, it's important to note because it is an important part of our nation's most affordable housing stock. And we also know that, many of these communities are disproportionately vulnerable to natural disasters, right? So maybe like in the, located in disaster-prone areas or older housing. So I think it's really important to be aware of that. And then, yeah, we also looked in depth, of course, at the racial and ethnic inequalities. So the national average is in orange here with 7.4. But then we found, if we look to the left, we found that Black homeowners are almost twice as likely as white homeowners to go uninsured. So 11% of Black homeowners did not have homeowners insurance. And we found that 14% of Hispanic homeowners did not have homeowners insurance. So again, I think it's very relevant to the middle neighborhoods kind of conversation that are more, ethnic and racially diverse. We see that these types of homeowners are disproportionately at risk. I also want to point your attention here to Native American homeowners. It's really difficult when you do surveys or when you analyze surveys like that, because they're usually there's only a very small number of Native Americans. So oftentimes there's a tendency to just leave it out or not talk about it. But I think even with the uncertainty around this number, to me, it was still striking. It was high enough where I thought, well, we definitely have to talk about this. We definitely have to include this. So we also see, this sort of trend of Native Americans to be much more vulnerable to going without. And part of the reason is kind of laid out in the following slides. So as I said, homeowners without a mortgage are much more likely to be uninsured, and among those are, of course, homeowners who have inherited their home. That's one way of going without a mortgage. They're also more likely to have an older home. They are more likely to be house rich, cash poor, right? So it's sort of a unique set of characteristics that also makes them much more likely to not have homeowners insurance. So in the report, we found that 29% of homeowners who had inherited their home did not have homeowners insurance. So that's a really high share of this group. And given that we're having all these conversations about heirs property, including in the context of middle neighborhoods, like it's not enough that we resolve tangled title issues and kind of multiple ownership kind of problems that kind of occur with heirs property, but also ensure that we can kind of find homeowners insurance and that we can guide people in sort of being protected, right? So both to the sort of intergenerational transfer of wealth, but also the stability of neighborhoods can kind of be protected through this. And on this slide, I kind of, again, I showed, when we're talking about heirs property, again, it's homeowners of color that are more likely to have inherited their homes. specifically again Native American, but also African American homeowners. So like around 8%, according to the American Housing Survey, 8% of Black homeowners had inherited their home. So it's a more important source of home ownership, frankly, for this group. All right, so I'm taking you to the geography of uninsured homeowners. So in our report, you will also find a list of all states. So we also have estimates for every single state. So I encourage you to look it up in the report and find your own state. But here I'm just showing metropolitan areas. So there's 15 metropolitan areas for which we had information through the survey. And we see kind of large discrepancies between different cities. So the cities with the highest shares of uninsured homeowners were Miami, 15% in 2021. This actually has risen to 22% in 2023. So we definitely see a trend there of more and more homeowners going uninsured. We see 10% in Houston. And I also want to point out that we saw like around 5% in the Los Angeles metro, which I think is really important also with current conversations. And we saw a slight increase there as well. Like so it was like 4.7 in 2021, and that it had risen to around like 5.4 or something in 2023. So we see a slight increase as well in Metro LA. And then finally, I would like to point out Detroit here as well. So 9% in metropolitan Detroit. So it's going to be for most of these places, it's going to be more in the actual cities, right, than just the overall metropolitan area. But this is the information that we have. Then final finding I'm presenting today is, this is not just a problem for individual homeowners. There's community-wide implications, but there's also kind of, systemic implications for when we're thinking about, our housing system and our housing finance system. So we wanted to put a dollar amount on this kind of risk. So, it's an estimate because it's based on, what these properties were worth in 2021. But we estimated that around $1.6 trillion worth in property value was at risk in 2021 in terms of the homes owned by uninsured homeowners. And then we saw that, homes owned by Hispanic and Black homeowners were disproportionately at risk, right? So it's equivalent to around $339 billion of property value owned by Hispanic homeowners, and $206 billion in property value owned by African American homeowners, right? So this is kind of the sort of what we're talking about here is not minor. Yeah, so I want to. There's a broader policy conversation to be had, and I think we'll perhaps address some of that too in a Q&A. But I just want to give you some kind of ideas of what we at CFA are working on and what we're seeing as kind of promising avenues. So first, I would call it HMDA for insurance companies. So it's the Home Mortgage Disclosure Act. So in mortgage lending, since 1975, all lenders are required to disclose all information about anyone who applies for a mortgage and who gets a mortgage and who gets rejected for a mortgage. And this data it's been very useful for advocates, but also for lenders themselves to kind of understand, who's not being served, what is happening. But we don't have anything like that for insurance companies. There's just not been that sort of transparency, and I think it's really important for all of us to push for more data and information on where, who they are insuring, where they're not insuring people, whether they're paying claims, whether they are non-renewing people. We just need more information so we can really understand where, how this crisis is impacting people. The next two bullets here are things that can be done at the state level. So insurance is regulated at the state level. So a lot of solutions will be state level solutions, and will require people to advocate in their respective states. So one is states and insurance companies need to do more to invest in risk mitigation, right? To to invest in stronger fortified roofs, clearing brush like around in fire-prone areas. But one way of, there's always a shortage of funding, including at the state level. But one way of doing that is to kind of require insurance companies to participate in resiliency investments as sort of a price of doing business. It's kind of like a community reinvestment act for insurance companies. This actually has existed in Massachusetts for the last 25 years. So there's a model that works and it has been renewed. And also states should require insurance companies to offer premium discounts when people are engaging in these sort of resiliency investments in their communities and in their homes. The third one is it really important that we have strong consumer protections everywhere. So one that I've been giving attention to is that many states, if you're late on your home insurance payment, you only have 10 days before your insurance company drops you. So for late payment, there's only 10 days. But you may not even realize that you're late on your payment at this point, and it's not enough time to find an alternative, right? It's not enough time to find an affordable alternative. California Code of Insurance actually has really good protections here. So they give consumers 30 days after they have received a notice from the insurance company. So the insurance company has to send a notice first, post-dated, and then 30 days. So consumers are not sort of stuck in the middle when a disaster strikes and are unprotected. And then finally, there's discussions about a federal backstop. So part of why insurance prices have gone up so much is because one reason is because insurance companies in turn rely on insurance companies to offset some of their risk. So they do not keep all risk on their own books, but catastrophic risk they often in turn insure for themselves through global reinsurance companies. But they're global. They may be in Bermuda or in Switzerland, and they're not regulated. We have no control over them. We've seen the cost of reinsurance really go up a lot in recent years. And that is all, the cost is being, consumers have to pay for it in the end, right? So there's talk about creating kind of a federal reinsurance alternative over which we would have more control, and which would be one mechanism to kind of regulate and moderate premium increases. So that was it for me today. Thank you. I know slides will be made available, but I'd also hope you have a chance to look at the report, because there's even more findings that I did not have time to present today. But I hope it was a good starting point for our broader discussion. I will turn off the screen share.
It's fantastic, Sharon. I have a couple of, let's see. I'll start with one question that I wonder if you could just describe for everybody, so we're on the same page about this, what the FAIR plans are and where they're available, and the same for the National Flood Insurance pool, because those are, I had to read up on them myself before doing this webinar to understand how they're not available everywhere and what they cover and what they don't cover and things like that. So well, go ahead.
Yeah, it varies a lot at the state level, right? So we have there's a FAIR plan in California, and there's the Citizens plan in Florida that are well known. Massachusetts also has a FAIR plan. So it really varies by state, and it depends kind of on the history of exclusion from insurance, right? So the Massachusetts FAIR plan actually came about due to historical redlining of communities of color in Boston. So that's sort of, it was impossible for people to find insurance. So we're talking back in the 70s, right? So it's impossible for people to find insurance. So that's why the state came up with a FAIR plan. But of course, the Citizens in Florida and California is more in response to our climate crisis right now. They're public alternatives, but it doesn't mean that they are affordable, right? So that's really tough. So it's great that they're there and it gives people an option, but it's the lender of it's the insurance of last resort.
That's right.
So it's tough. Yeah.
some states have FAIR plans, and I think FAIR stands for fair access to insurance, something, right? And some states don't have a FAIR plan. According to my reading, so you can check me on this, the FAIR plans are something that a particular state will require insurers to create themselves if they want to do business in that state. So it's a self-insurance pool, or the risk is shared among all the insurers in that state, I think. So it doesn't actually have public funds in it. Is that right, Sharon?
I think it depends on the state. So in California, there's a lot
Okay,
of talk right now about, the FAIR plan does not have enough funds in it
yeah.
to pay out all the claims. So this will be funded by an assessment on all people paying insurance in California, including paying for private insurance, right? So that's what you're talking about. Yeah.
Yeah, yeah.
Yeah.
And then what about the flood uh pool, the National Flood Insurance?
Yeah, so so homeowners insurance often has exclusions, right? So sometimes you have to oftentimes you have to buy separate flood insurance if you are located in a FEMA designated flood zone, which by the way are changing now too because of new disasters, right? So some homeowners may feel or they thought that they were not living in a flood zone and all of a sudden they are, right? So um, that is there is private flood insurance that you can buy too, but the National Flood Insurance Program offers another option for homeowners to buy flood insurance through that program. Yeah,
Particularly where there just is no other private insurance available, right? That's
yeah,
especially true. And it's a federal program, whereas the FAIR plans are
yeah,
state
that's
by
right.
state. And can anyone explain to me why uh, our insurance industry is organized by state? And is it just one of those inexplicable things about living in a
It looks like Tiffany
federation?
has a thought about this. um it's it
Most,
it has yeah
go
it
ahead.
it has upsides and downsides, right? So
True.
it's because it's at the state level. uh as advocates sometimes it's hard to really, it's like, oh, we have something great in California, but then it may not happen in Kentucky, right? Or we have something great in Maryland, but then there's going to be a divide between red states and blue states. At the same time, like it does give us that option to sort of like have the federal government's that,
Experimentation.
yeah,
Yeah.
experimentation. Like there's a lot of great innovation that has happened at
Mhm.
the state level. So I
True.
think it's a double-sided sword to kind of deal, but
I
I
think
don't
a
think
lot
it's
of
going to
people,
change anytime
yeah,
soon.
I don't
So
either. And I think, I mean, having been a person that has changed states of residency, to be honest, I was shocked at how spectacularly different health insurance options are from one state to the next. And I bet most Americans have no idea how different those things can be. And so homeowners insurance can be the same way, I guess. It's it's very interesting. Okay, enough of satisfying my curiosity, but I thought that the FAIR plans and the federal flood insurance are things that people aren't necessarily completely clear about. And although they do fill a gap that the private sector leaves, they are not an ideal alternative to or an ideal fit for the situation at hand. So once again, I just want to introduce Bob Pivick from Healthy Neighborhoods Inc. in Baltimore and Tiffany Smith from Chicago from the Mansueto Institute and formerly NHS Chicago. And I think I want to toss a question out to Tiffany. And by the way, participants, you can keep putting your questions in the chat or in the Q&A and we'll work them in. But for Tiffany, I wondered if you could take us from the big picture Sharon just described to a very hyper-local example of how you dealt with in middle neighborhoods in Chicago, um, hands-on, very, very practical programs to try and keep your homeowners insured and at the best rates they can get.
Yeah, I think a lot of it starts with education. And I see my colleague, Mr. John Groney, in the chat over here. So he's actually going to back me up while I'm talking. So I love
Okay.
that. But so it really does start with education, right? So in our work when we were at Neighborhood Housing Services of Chicago, we partnered very closely the neighborhood strategies team and our home ownership counselors to work with our residents who maybe said they're having trouble paying their mortgage. So that other percentage that Sharon's talking about of the people who are in mortgage and they're like, hey, my insurance is posing a problem. What we were finding were a lot of those folks who were coming in for intervention, foreclosure intervention. It wasn't the mortgage. Most people learn, we figured it out after 2008 going, okay, look, can we get as many people on fix, right? And so the PI part of the PITI was stable. It was the TI or the last part of that, which is the taxes and insurance, which then impacts that escrow account and that monthly payment, which initially you think, oh, that's predictable. This is how much I can afford to pay. As the taxes increase, as your insurance increase, we started seeing people get into trouble. And so my colleague John, who it was his brainchild, we started rolling out what we called PITIE consultations and education workshops. And the P, of course, is the principal, I being interest, T taxes, I insurance, and E energy, because we now have another component that impacts our monthly cost of home ownership as things have become deregulated across the country. So making sure that our residents, our homeowners, were paying that lowest regulated rate was also key to that. So from an insurance perspective, though, it was really about making sure every one of our residents that were in our locus of control and were partnering with us along this um, journey we call home ownership, really took a look at their insurance every year, right? I'm one
Mhm.
of those inherited home people. And one of the first things, as we were transitioning the home to me was, hey, you got to get insurance. Go call Bill, who was our insurance provider for years, and switch it over to your name. And what we learned is I was a young person, so credit wasn't great. And what they would have charged me versus what they charged my dad it was a big difference. And even the actual our insurance person was like, your father will kill me. No, 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 hold on, let me send you somewhere else, right? But you don't get that experience from everyone else, and everywhere you go, and not everyone has those relationships with their insurance provider. So what we've kind of drilled into folks head is they're not loyal, you don't be loyal. I need you to every year shop it around. Do not get rid of your insurance until you are firmly into your new one. But if you are claim free for 3 years, you shouldn't have any exorbitant increases. So let's really take a look at this and shop it around at least 3 providers, right? And make sure we're getting the best deal and we're making the best spend possible. Yes, we love our relationship. Yes, we love the service. But if I can get comparable service, comparable coverage at a lower rate, because I'm a new customer, then go for it. This is it. There's no loyalty here. There is no loyalty to us. In fact, they have said our providers or the insurance industry has said that they are using price optimization. And so folks will pay because they have that relationship. They don't really understand the product anyways. When you're shopping around, it's very rarely apples to apples. The nuances, there's just a little bit of change in the wording. So you're like, wait, am I getting the same thing? So it's not so easy to shop around. And so a lot of people will avoid the headache and just stick with what they've got. And the industry knows that. And so it is what the market will bear. We will continue to increase those charges. That's one component of it, right? So the education, super duper important, making sure you're being proactive and we're advocating for ourselves. Second part of that is really partnering with our city government. So City of Chicago, the city that works, my hometown, born and bred. While we may have challenges in a lot of ways, one of the things I will say we have been consistently committed to is making sure that we support our existing homeowners, whether it be through upgrades and exterior improvements in our middle and lower income neighborhoods. So we have been leveraging those grants to say, okay, if you're getting a new roof, part of this process after you've gotten that roof is I need you to circle back with your insurance provider, right? We want to be getting discounts wherever we can, because again, it's about decreasing that monthly cost to home ownership on all fronts. So leveraging those rehabs that you're doing in your home as a value add, those retrofits, those of us who are from Chicago that are on this call know that no, we're not so much we don't deal with fire so much, although this week threw us a curveball. But for us, it's water. Water everywhere, right? So in the springtime, the flooding, particularly on the south side of Chicago, in the Chatham community for which I'm a resident, it is a constant struggle. And the city has done things to kind of, fix the sewers and things of that nature. But we have a lake that's the size of a sea. And we have a lot of concrete, and so it doesn't always absorb all that water. And typically, our Black and brown homes are built in those neighborhoods that tend to be more flood prone. So we are seeing more and more of these. How do we battle this? FEMA has done natural disasters on in the south suburbs and on the south side and on the west side. In the last 2 years, it's happened because of water. So making sure that is it flood protection that I need, or is it sewer backup protection, right? Understanding those differences, that's where the education comes in. But then also, what are we doing to improve our homes? Are we doing French drains, right? Are we doing sewer sump pumps in addition with the ejector tank? Creative solutions to manage water, because we know every time that water hits our home, it decreases the value of our property. We're already dealing with challenges of appraisal gap in our Black and brown communities, and this tends to exacerbate the issue. So I'll pause
Yeah.
there. Were there any questions on that?
Can I think this is a great little segue. I wanted to pull Bob in because both of you either work at or have worked at organizations that do a lot of rehab lending. So it's kind of nice that you have that big tool right there. But I am wondering, Bob, well, first of all, Bob, why don't you describe Healthy Neighborhoods, Inc. to us a little bit and what you do and why middle neighborhoods are what you invest in and how insurance affects them. And then we'll sort of move to, I'm sort of curious whether for either of you, you've experienced that lack of homeowners insurance has prevented you from making a rehab loan to somebody, because I've heard that in other places. So go ahead, Bob.
So just quickly, and thanks, Sharon, for your research, and thanks, NCST, for pulling these together. Interesting being on this side of the table for it. But I'm still taking notes and learning from what I hear, so it's not that different, really. Healthy Neighborhoods, Inc. for 20 years plus has been combining community organizing and mobilization with capital investment to help support middle neighborhoods that we see as sort of chronically undervalued due to the long history of troubled history of racist and anti-urban investment patterns that exist in our country. And we work in a tier of middle neighborhoods in Baltimore City, neither the most disinvested areas nor the wealthiest. And the centerpiece of our capital program is a rehab mortgage product or suite of rehab mortgage products. We also have other things we do, but that's kind of the biggest impact we've had from the capital side, making loans in these neighborhoods for 20 years. To get to your question a little bit, I did a bit of a survey with the banks. Our loan is funded through a pool of lenders who put their funds in and we issue the loans under the terms they agreed to create the pool. And we haven't found a direct impact in many cases. We could point at and say, oh, we're going to make this loan with the insurance, seem like we do find a couple of things. One, it has escalated quite a bit, and I guess maybe it's in our rate environment where it isn't sort of seen as the inhibitor to people passing debt coverage ratios and stuff. But we have seen it go up rapidly and way more than any other index we would look at. Number two, the ongoing insurance has become an issue we've heard about as well. People getting escalating rates, people, when people fall into delinquency, we, you know, intervene and well, I don't know if I can use the word intervene, but we contact this person and, you know, try to assist them. We are a bank after all. And and we do hear that it's the T, the I, and the E sometimes, and I love that, Tiffany, adding that E on there. I saw it in something and I was like, what the heck is that? Adding energy to the concept of these are sunk costs that you better, you know, cover every month. And so anyway, we have found that it is those ancillary costs that might be called ancillary that are tripping people up in our servicing work. You know, we are not a housing counseling agency of our own, but we have partners we work through with to deliver those services. And you know, coming out of this, I think it would be useful for us to be more mindful. Like post-closing counseling is something that has come to our attention as more needed, and we've been trying to figure out ways to support our partners who do the counseling and that, because I'm sure they don't get funded for it through the normal stream. So, you know, I have to make sure this is piece of that puzzle. I'll leave it there for now.
Well,
So can I
that's
add
really
something
interesting.
onto that,
Yeah,
Marcia,
please.
with the housing counselors? There's a shortage, people.
Mm,
And so I'm so glad you said that, Bob, because a lot of our HUD certified, and remember, a lot of these folks, they had to get HUD certified now. It's not just you can hang your shingle. So there's a process you go through. There's tests you have to take. And so we do not have enough of them. And funding those roles has been a challenge. So I'm so glad that Bob brought that up. Like we've partnered in my previous life at NHS, we would partner with Freddie Mac. We would partner with, you know, Associate in those types of different banks because they got it. They're like, okay, we need you to help us on the pre-purchase, but there's also that post-purchase counseling that's vital for making homeownership sustainable, right? It's one thing we put them in the boat, and if we're leaking them out the bottom, then that's not going to help us anywhere. So that post-purchase counseling is key. It should be part of the life cycle when our lenders are having that initial conversation and building that relationship. That should be reinforced that, by the way, I need you annually doing these things to make sure you're staying healthy in this, financially healthy throughout this whole process.
That's a good point. And, you know, I think I want to pull in somebody whose face no one ever sees, but Ann DePetta is behind the scenes on all of these webinars, making sure they go smoothly. And it just so happens that Ann also does all the home buyer education and counseling for NeighborWorks organization in Ithaca, New York. In addition to that, she teaches home buyer education in the trainer's format for people who are seeking certifications at the NeighborWorks Training Institute at a national level. And would you jump in and just describe, I believe that you are developing a new module on homeowners insurance to add to the existing curriculum for home buyers. Yeah, there she is. There's our Ann.
Yeah. Hey, Tiffany inspired me long ago with the training related to insurance, and we're really lucky in Ithaca because we have a very committed pool of attorneys and lenders and realtors and insurance agents who are willing to come in and help us develop and then also help us do this training. And so a few years back, we developed several post-purchase modules to help those who had already bought their homes to protect their asset. One of which is definitely our most attended, which is the wills and estates. So some of this plays into that, and that is a really great class. And we have a local attorney who leads that, and she's phenomenal. And then this year we decided we were adding a couple extra modules to that, and one of them was insurance, because it is an ongoing issue for anyone, or it's just something to be thinking about if you're a homeowner, and how your insurance needs may change after you buy a home and what happens after your mortgage is paid off. And so all those nuances. So we are in development. We're going to be launching that probably September.
And are you launching that only at your local organization, or is this going to feed in eventually to the NeighborWorks approved curriculum?
That is hard to say.
Okay, so we're
I don't know
hopeful.
these two worlds. So I do live in these two worlds where I'm a practitioner locally, but I also
Mhm.
train at the national level. These two worlds talk to each other all the time. So,
Okay.
so it's possible.
I certainly would be interested in following up with Anne to see if there's a point at which we can make sure that her curriculum for the insurance module is available to anybody else who would like to use it. I think that would be helpful. Okay, so let's,
Can I add
yes,
something else, Marcia?
Tiffany, yes, please.
Sharon touched on it a little bit or a lot actually, in her slides and in her research about the inherited homes
Yeah,
and the tangled titles. And tangled titles, huge issue, right? I'm so glad people are talking about it more on the national level. But also, let's talk about what we need to do and what we're doing to be proactive so the titles don't get tangled, right? Uh,
yep,
so really a lot of that, again, post-purchase education and counseling really does need to shift and make sure we're talking about it from when you're in home buyer education all the way through the process. What does estate planning look like for you? Right. And every state is different, kind of like Illinois has our Illinois Fair Plan. Everybody has different state insurance things. The tools in your toolkit for low cost estate planning are different everywhere you go across the country, right? So we're super lucky in Chicago. I partner with the Center for Disability and Elder Law regularly because they can provide low to no cost services for those with disability and elder or folks that are greater than 60, right? But going through the process of, do you really just need a will? Maybe let's look at, for this property, we're going to look at a transfer on death instrument, which is super low cost, right? They're
yep,
not going through the whole probate thing. Is that appropriate for everyone? No. But when it is appropriate, let's go ahead and make sure we're taking the path of least resistance and making sure that your will, your wishes are intended as they were intended, are fulfilled. And your biggest investment for most people is actually responsibly taken care of after you have transitioned. The second part of that whole tangle title and estate planning process is working with our banking partners, which I don't think we've started having this conversation enough. I've started whispering in people's ear, but working with our banking partners to come up with the equivalent of an escrow, but it's once you're outside of mortgage.
yes,
Because here's the one thing, I always use myself as an example. I am that person. Um, Inherited the house,
do.
did the mortgage thing, right? And finished paying the mortgage. Was so proud of myself. And then I got that first tax bill, and I was like, Dad, I think I broke something. I don't know. I did something wrong. I got this bill for $4,000. And he's like, yeah, it's a tax bill. I didn't pay that before. He's like, yeah, you did. You paid it monthly. So wait, what do I do now? I have to write a whole check for $4,000? Yep. Twice a year, you're going to get it. Well, so let's think about this, right? My dad, when he bought the house, right, had a two-family income or two-person income. He was making a lot more money than I was at the time. So, and he's making monthly payments. I'm making less money, single person, and I have to write a check. That doesn't make sense. We pay our student loan payments in monthly increments. We pay our car notes in monthly increments. Why wouldn't we look at setting up some type of financial product or account that allows you to put money into the account? Can't take it out, but put money into those accounts, right? For those purposes.
Yeah, that's a really
Putting it
good
out
point,
there.
Tiffany. It's not, there's so much vulnerability that happens the minute a mortgage is paid off that we basically, nobody knows anything about, right? We need to be, if we're in the business of being proactive in helping our neighborhoods succeed and the people within them succeed, then we start to maybe be needing to be proactive about that as well.
And that's the seniors as well, right? So
Yeah,
if Graham is going to pass this along to Jason, but we know Jason is an artist, he's responsible, but he's an artist. He's just not making that money. Then
I get,
is it
oh,
that Graham is actually setting up that account so that it covers that insurance, it covers those taxes for 3 years afterwards. Now, Jason, you're gonna have to figure it out after 3 years, but at least you've got that cushion. Because here's the thing, right? If Graham had the house, if there were exemptions, if there were discounts on the insurance because there was a senior there, or anything that went with that, well, those fall off when Graham dies. So his costs are actually more than hers.
Yep, that's right. I'd like
Marcia,
to get
I have a quick kind of comment and question for Sharon. Actually, I also want to circle back to the climate related issue. A lot of our comments in the
Yeah, we
chat,
have a lot of
and
people. Mhm.
luckily Baltimore hasn't been hit by something like that, at least lately. But the part of the paper that really resonated for me was the kind of redlining related conversation, and the sort of bias inherent in how insurance is distributed across the landscape by race and income, et cetera. The and that really is a challenge for both our homeowners and our development community. Like, insuring a vacant building in our city is getting harder and harder. We've had companies say, "Oh, we don't do that anymore. Just pull out." And we have 14,000 of those, and everybody's working to bring those back online. Living next to a vacant property is a little niche problem we have. Your insurance will
Yeah.
tip you for that. Most of our housing stock is attached row homes. I just wanted to call that piece of it out, and the relationship with the CRA and HMDA data and all the things that have happened on the lending side to help regulate this. And, lack of equity problem is a little over my pay grade, but, that is probably the approach that needs to happen do you agree? Maybe Sharon, is that the approach that needs to happen on the, on the insurance side, like something top level like that?
I mean, comparing mortgage to insurance, we just have such a strong framework for protecting fair housing in mortgage, right? Like we have the Community Reinvestment Act, we have HMDA, we have a lot of fair housing litigation. Like, we're on top of that, right? We're really ensuring that lenders are not engaging in redlining anymore, because that's sort of there was just this. I mean, we have this long history of redlining that's really shaped an awareness about that, and sort of we're still working on kind of continuing to prevent that. Whereas somehow the insurance industry has sort of escaped the same scrutiny, and they've worked hard to try to say, for example, that the sort of disparate impacts part of the Fair Housing Act would not apply to insurance companies, right? Which is false. But they're trying to claim that there's sort of a carve out for them because somehow they are not part of housing. But I think in as this crisis is not just impacting places like Baltimore, Detroit, right? It is becoming it's starting to impact a lot more neighborhoods. I think that argument is becoming more and more untenable. And I strongly believe that we have to draw on say, well, why don't we have HMDA for insurance companies? Like, why don't we have sort of state CRA for insurance companies, right? So I think part of the reason that it has been so difficult is exactly because it's regulated at the state level. It's been harder to kind of impose those sort of federal standards on it. Like, even when I say HMDA for insurance companies, it would likely sort of happen. The collection of data would happen at the state level, right, and at the state insurance offices. So I think that complicates the matter. There's also new redlining is a continued, like, it's a continuing concern. And I think there's also talk now about how it's called blue lining, right? Like how redlining now starts to intersect with climate risk. And that some communities of color in particular are being blue lines, right? So they're being seen as too risky. And there's this carve out. So we're starting to look into that. Like, I think one obvious area that we can tackle here is that insurance companies are still allowed to use credit score information to price differently, price unequally. And I think this has huge racial equity impacts, just because we know that due to historical discrimination and sort of historical, wealth inequalities, many communities of colors, have lower credit scores on average. So why are they paying? Why? Why are you paying more based on your, whether you have medical debt or like whether, because you were late on your car loan or something like that.
Mhm.
Yeah.
I mean, student
Yeah,
debt
that's
is
a
also
real
one that impacts it. Yeah.
a real problem. And I'm kind of glad where you took the conversation, Bob, because I kind of wanted to move into policy advocacy. And I guess one of the good things about insurance being regulated at the state level is that we're that much closer as local practitioners to being able to interact with that policy. So I guess I should check with whether either Bob or Tiffany have had that experience of, do you know who your insurance commissioner is? Do you, is it ever a place where your organization tries to do any advocacy? And, between the two of you and Sharon, like what could be some ways in which local practitioners could start to do some advocacy at the state level?
So what I will, yes, I know who our state insurance commissioner is.
Very good.
And here's what I will tell you. The data is a challenge to
Yep.
gain access to. And having, yeah, that's the problem. I got to be honest with you, right? Because you are basically reaching at stars because understanding who's getting charged what by where and trying to compare apples to apples, but really there's no apples to apples. It's apples to oranges to pear, is problematic. So I get that there is nuance for all of our properties and situations, but there does need to be some standardization put out there across the board so that we can actually understand where the needle is and start measuring from there. What I will say though is, so yeah, first order of business is if it's not on the books where you are, you got to be working to get the data out to the community and make sure this process is a bit more transparent. And understand who's paying for what and how much it's costing where. And I, I have suspicions about the whole blue lining and redlining and the impact of the cost of insurance in Black and brown neighborhoods, which is why we so vigilantly encourage people to shop around so that they can get lower rates, even if it is still you're paying more than if you were in a different neighborhood. But from a policy perspective as well with our insurance providers, when we started talking about this whole webinar, I was talking to one of my good friends, Sonari Glenton, who's like a reporter, journalist guy. And he's like, in Los Angeles, Park La Brea was built by an insurance company. And I said, wait, what? He goes, yeah, they used to do that stuff all the time because they were structured to be of mutual benefit for their members, not their shareholders. So I think where we have opportunity is partnering with our government officials to incent our insurance providers in who are operating within those city limits, who are operating within the state, to invest with incentives for investing in some of these public initiatives, infrastructure initiatives, which ultimately will lead to lower costs for them down the road, because we're going to be making these communities more resilient and these structures more resilient. And I'll pause there.
That's
Can I
great.
can I speak to this
Please.
policy? Like Tiffany, I completely agree. I think that's a very important initiative because we can turn to the state and be like, oh, we need more money for this, but it's very difficult. But I think kind of thinking about this sort of model of, so insurance companies are basically they're large investment portfolios, right? So they take your premiums, they take people's premiums at the beginning of the year, and then they kind of work on year-long cycles, right? So for homeowners insurance, so they can invest these premiums and they get returns on these investments, and then at the end of the year, the difference between claims and premiums plus their investment returns, that's their profit, right? So investment is really important for them, right? And right now there's a lot of talk about why are insurance companies investing in the fossil fuel industry that's actually making our risk worse, right? So there's a model in Massachusetts. I'm having a blog come out probably about this today. Also, there's a model in Massachusetts for the last 25 years. They have had sort of a model where insurance companies can get a tax break on their investments, on their income tax, if they participate in investing in housing, infrastructure, community, right? So if they do, and if they do that, they become stakeholders in community as well, right? Like they become invested in the community, and they're not just sort of like, oh, well, the risk went up. Okay, well, this is the new price for this risk. And if you don't like it, then, then I don't care. Like, I just won't insure you, right? So, bringing in insurance companies as partners, being invested collectively in communities as a way to, reduce collective risk, right? And not just like price for whatever risk kind of comes up. I think that's a really important policy to kind of advocate for when you are a local or state level practitioner with your kind of state insurance commissioner. I think for me, it seems like a low hanging fruit. And the nice side effect is that it would, bring in more money into housing and community development as well, right? So, and it's not charity, right? Like they get returns on those investments. In fact, they, historically have been very good investments, right? It's just kind of motivating them to sort of, it may be kind of new for them, right? Like that's not what their investment portfolio has traditionally looked like, right? But sort of bringing them on basically to start doing that more. Yeah.
What do you think, Bob, about advocacy at the state level?
Well, it sounds like a great idea. I can assure you we have not participated in it. I think for us, it is again one of these one of these many topics that in our communities that I'm thinking of the William Julius Wilson book as work disappears, thinking of as debt disappears, like debt, and I'm not like the world's biggest capitalist, but it really creates this structure in which the insurance happens and the title happens and the estate planning happens often. And, when our communities fall below a certain level of economic sustainability and the nature of the marketplace and debt disappears, all those things crumble for us, so there's title and abstract problems that, we could talk about entangled title issues and probably should here if we haven't done a webinar on it. But, so that collection of issues piles on top of our day-to-day work, and in many ways is why we try to focus on raising the tide of the neighborhood as a whole in the marketplace. And our catalytic capital is meant to, we're not trying to be wantonly gentrifying places, but we do need to achieve a level of sustainability if we expect people to make loans and then the debt to service all of these problems. But insurance is a really tricky one because it does sort of arch out of that envelope as well. So anyway, I'll that's a little more theoretical maybe, but I think that it is something we should get to know our insurance commissioner. I looked up who it was when I was invited to sit on this panel. I had no idea.
We're all Googling frantically, right? Who is
So there's
this
plenty
person?
of work to do on the advocacy front.
Yeah, it sounds like we're at a place where it's time to educate ourselves, those of us who are in community development, and educate ourselves enough that we can start to educate others. And it doesn't help that people are, in some cases, paying people a lot more money than we make to make sure we don't have the data that would allow us to draw attention to the problem in a very specific way. But, it can't be that way across the board. And Sharon, I wonder, like, is there anybody nationally who's taking this issue up? Who's in charge, or who's claimed the ground of dealing with the insurance issue on a national level?
So CFA is a key player here. The Consumer Federation of America. We continue to do a lot of work on this. There's a lot of we work with the Climate and Community Institute, which is a group of researchers and academics that work on this issue. United Policyholders has long been a resource on homeowners insurance, and then the Green Lining Institute out of California. So there's a lot of like I think insurance traditionally has been this sort of dry,
Yes,
really
the most
cares.
boring thing ever.
Yeah, and now we see more and more interest, and I see some of the first voices that are out there are more at the intersection of insurance and environmental justice. But I agree that there's a lot more room for national voices, especially when it comes to housing finance, mortgage servicing, threats to homeownership and insurance. I think I know that in the next year we will see a lot more work come out about that. We have to give organizations a little bit of time to educate themselves, learn. But I'm hopeful that there will be more. Yeah.
Well, let's all hope that
Marsha,
yeah, go
can
ahead.
I also add on that one? Making sure that you understand or look in your state to see if you have a fair plan equivalent, and understand how that works, right? So in Illinois, kind of what you were talking about, Marcia, you actually get your policy from an actual insurance provider, but it is through the Illinois Fair Plan because that is the provider of last resort. It is a nonprofit. It is everyone putting pool money together to secure that. So making sure you understand how your plan works. If there is one in your state, and if there isn't one, how do you get one? How do we make one? How do we encourage that behavior? But the second part of that is making sure you're staying aware of the rates, right? So in Illinois, across the board, our homeowners insurance went up by 9.4% last year. That's not small.
No.
That is impactful. And so, but understand too, even under Fair Plan, that means increases are taking place there as well. And so what we saw as the provider of last resort, we're actually now seeing that it is not financially feasible, even though it is the provider of last resort to our residents.
Yeah.
So making sure it is, if it's there, is it really an option? And if it isn't, what do we need to do to go in and retool this solution?
I'm glad you mentioned the FAIR Plan because we really haven't taken on the big question of that a couple of people put into the chat, which is if they live in an area where there is no private insurer to offer them anything, what are they supposed to do? And hopefully you at least your state has a FAIR Plan to look into, as Tiffany just described, and see what those options are. But is there, is there any advice to give people besides educate yourself about what's available and guide to the best of that knowledge your citizens toward those options? Sharon, yeah.
In terms of for consumers, like, what to advise them, I think it's very important that they understand, like, well, what level of coverage do I need, right? I think we've talked about uninsured, but there's a lot of people that are underinsured too. Right, so they will have to accept something with very high deductibles, right? Not everything is covered not all claims will be covered. So I think it's really important for people to think about that, like, well, what kind of coverage do I need, and is this policy, does this work for me, right? So I think it is one strategy to sort of achieve greater affordability, but it has to be, you have to understand what you're signing up for, right? So I just want to bring that underinsured also to the table. Yeah,
I think that's right. And well, I hope it's not just me. I don't think it's just me, but I think there's an enormous amount of learning that needs to happen really quick. I think this issue snuck up on us, a lot of us, and it's very murky. So it's time to sort out all the moving parts in your own state so that you can advise people, and that maybe if you're in the home buyer education business, you can start to develop curriculum around this like Anna's doing. That if you're in the lending business, you can start to think about alternatives and things like how to work with people to get insured so that they can access your lending capital. It's probably, I mean, I am a person, as obviously I like to convene people to talk about stuff, right? I'm itching right now to organize roundtables on this in my own state, you know? Let's bring together the lenders and the insurers and the advocates and start to get our arms around this issue. Oh, one question I had for Tiffany maybe and Sharon is, I have a plane going overhead. Do the FAIR Plan organizations, do they tend to be a sympathetic ear toward the issues that we're facing, or are they more like representing insurance companies and their stockholders, shareholders? I've never met one before.
So I won't speak of an industry as one, right? What I will say is, in my experience, Tiffany's experience, the folks that we've worked with have very much understood the challenges that we are trying to address. That's kind of why they're there. They do operate as nonprofit in the state of Illinois, but they also understand the reality of the situation, which is there's this insurance we're providing you, but there's also a reinsurance market that we have to tap dance in as well.
Okay, that's a good thing for us to learn about as well. But it could be also a place to, I'm thinking, to touch base, to be one of your first stops if you have a FAIR Plan organization, to learn from them, because they're probably way up to date on what all the issues are in the state and know what data there is to the extent that it exists.
And I
Sharon,
think, yes, I think also too, if you're doing a convening in your state or municipality because you're, someone who works in this area, not only are you going to want to have your lenders there and your providers and your home CDFIs or your home counseling folks, you're also going to want developers at the table too, quite honestly, right? Because that's part of the challenge a lot of folks are facing. You are insured, to Sharon's point, but you are actually underinsured because of the cost of rebuild now and the cost of land and things of that nature. So like my heart is breaking, right, for a lot of the folks up in Altadena who are insured. And we're not even talking about the ones that aren't insured, who are insured, but where are they going to rebuild? Where does that money translate to in California at this market, at this rate?
yeah.
It's problematic.
Tiffany raised the issue of developers. Someone in the Q&A asked about multifamily affordable housing developers and sort of where this is affecting that, and the answer is that it is, right, and that it's very difficult for affordable housing developers to make the math work because they are serving low income, like the rent is sort of set as a percentage of their tenants' income, so there's a ceiling. They cannot really raise rents as a result of increasing insurance costs. So they're an important ally here in terms of raising this issue and really, talking to lawmakers, because it's affecting both existing affordable multifamily developments and like ones that are in the pipeline, right? And there's also concerns about redlining specifically of affordable multifamily. For example, I've heard like stories that like on the long questionnaires to qualify for insurance, there's questions about like, what sports do your tenants play and whether there's voucher holders in the building, right? So sort of like, I think one of the problems too with insurance is that there's a lot of proxy discrimination going on, right? They're like, they may not be using race, but if they're using, I don't know,
something that correlates with race,
exactly.
It has the same effect. That's right. And by all means, those credit scores, but yeah. And there are certainly, I have noticed one of the national nonprofit that is sort of the Association for CDFIs, HPN, what are they? Yeah, okay. That organization, I apologize for not being able to pull their name out of my head.
Are you talking about the Housing Partnership Network?
Am I? Is that the CDFI?
OFN, Opportunity Finance.
OFN, Opportunity Finance Network. That's who I'm talking about. Thanks, Bob. I feel like they are really wrestling with this issue in a big way, and that they may even have started to create their own insurance pool for their members. Don't quote me on that, but I think it's worth looking up if you're a developer and, you know, a nonprofit developer too, in particular, and want to know who's taking the lead on that issue. I think they're doing a lot with it. I have to pull us to a close, unfortunately. I do want to remind everybody that the questions in the Q&A were answered offline by Sharon. So those answers are there for you, and maybe we'll try and put them in our follow-up email, which we do to everyone who registers for our events. It'll be a follow-up email that will have links to the recording of this webinar, a link to where you can download the slides if you want to try and use those with other audiences, and then sometimes other resources that we come up with during the webinar. So we'll try and download that and put that in there too. You know, my heart goes out to every one of you out there that are trying to do this work with yet another thing coming at you, particularly those of you who are working in areas with, you know, a lot of risk for natural disaster. It's whenever we have to deal with crisis, it keeps us from doing the day-to-day work of strengthening our communities, and it's never a good thing. So we have an engagement chat coming up on February 26th, where we're talking about neighborhood fundraising strategies, and you can email Anne if you want more information about that. Please email us if you have ideas for webinars you'd like us to do, case studies to write, etc. Check out our colleagues at Center for Community Progress who offer webinars in their Cornerstone series that are great. And please tell us about your experience today in our evaluation. And if you're not a member of the Middle Neighborhoods Community of Practice, you will be now because you signed up for this webinar. And that just means that you will have the opportunity to hear first about our upcoming webinars and other stuff that we're working on. And you also have the opportunity to reach out to me and request referrals. If you want us to do a local webinar for your community, there's all kinds of stuff that we're here to support you in your work. So thanks to our speakers. Sharon, you're just really a gift to our industry. I really appreciate your work. We're going to follow you closely. And Tiffany and Bob, it was really wonderful of you to jump in and give us the insight of what this looks like on the local level. If anybody out there starts to do advocacy in their states, let me know. I'd like to keep track of it. Thanks, everybody. Have a great rest of your week.
Thank you.